Good day. Today I'd like to make a few comments about capital structure. One of the major decisions that corporate treasurers make is concerning the financial structure of the corporation. This is the structure of the right-hand side of the balance sheet, the debt, short-term and long-term, and the equity. Financial managers decide the project that creates the most value, and then they decide the mix of capital that also creates most value. You should alter the shape of that right-hand side of your balance sheet when it maximizes shareholder value. How leverage affects the value of the corporation is the subject of capital structure. We'll start this discussion with a simple analysis of EPS, earnings per share. What EPS tells us is that leverage, in most cases, as long as you're beyond a break-even point, increases the earnings per share. This is a good thing of leverage. Let me give you some numbers. We show the schedule of earnings per share of Leverage Corp for various levels of earnings and for two states of the corporation. One in which the corporation has no leverage, and the other where the corporation has 50% leverage. We're interested in earnings per share rather than gross earnings because we're interested in the wealth of the current shareholders of the corporation. If you owned a share in this company, you would be interested in how much earnings that share entitled you to. The number of shares outstanding initially are 2 million. Price per share is 100, and so the equity value is 200 million. Here are the earnings per share of the firm. Earnings per share are simply the earnings before interest divided by the number of shares. Earnings go from $1 million to $40 million. Earnings per share go from 50 cents a share up to $20 a share. Now let's buy back half of the shares. We pay $100 per share, the fair price of the shares, to buy them back, and we get the money for it by issuing debt. So the principal of the debt is now 100 million. The value of the shares is now 100 million. So it's a 50-50 debt equity company, or the debt equity ratio is 1. Interest is 10% per year, and so our interest payment is the debt principal times the interest rate. So we have to pay, regardless of the state of the corporation, $10 million a year. Earnings after interest run from $9 million up to $30 million, the $40 million less the interest. But our earnings per share, since there are only 1 million shares rather than 2 million shares, now range from negative $9 per share all the way up to positive $30 a share. The leveraged corporation, beyond this point, has higher earnings per share than the unleveraged corporation. Below this point in earnings, $20 million in earnings, the leveraged corporation's shareholders have lower earnings per share than the unleveraged corporation's shareholders. What is the significance of the break-even point? If the earnings before interest are $20 million and there are 2 million shares outstanding, then the earnings per share is $10. If the company is leveraged, from the 20 million earnings before interest, we have to subtract $10 million of interest, giving us 10 million earnings after interest. If there are 1 million shares outstanding, the EPS of the leveraged firm is also $10. And in general, whenever we do leverage analysis of earnings versus EPS of a leveraged corporation versus an unleveraged corporation, there will be a break-even point. And that break-even point will be the point at which the earnings yield on the unleveraged firm is equal to the interest rate. We could think of the firm having an expected $25 million of EBIT, and that would give an EPS of $15 per share for the leveraged corporation and $12.50 per share for the unleveraged corporation. So that would be our expected earnings before interest. And we could think of the corporation having a range of potential EBITs. That range of potential EBITs would translate into a range of potential EPS. The volatility of the earnings per share of the unleveraged firm, here the light blue line, is less than the volatility of the earnings per share of the leveraged firm, here the purple line. So another way of expressing the effect of leverage is that leverage increases expected earnings per share, but it also increases the expected volatility of earnings per share. So we have a trade-off here. If the expected earnings yield is greater than the interest rate, then increasing leverage will increase earnings per share. But increasing leverage will increase risk as well, and shareholders, as you know, must be compensated for the risk in their cost of equity capital. But there's something else that you should note. If shareholders can borrow and lend at the same rate as the firm, then they can synthesize a leveraged company. Going back to our spreadsheet, we have a column here called homemade leverage. This is the synthesizing of leverage by the shareholder if the company wishes to remain unleveraged. Remember that the company originally had 2 million shares outstanding, a price per share of $100 for an equity value of 200 million. Now let's say that instead of owning one share, the investor decided to own 2 shares, but he only had $100. So if he borrowed $100, he could buy the second share and then have share value of $200, but he'd have to make interest payments per year of $10. What would the cash flows to the investor look like? He would have the EPS of the unleveraged firm, but remember he has 2 shares in the unleveraged firm, so he multiplies the EPS by 2, and he subtracts from that interest per year of $10. So when the EPS is 50 cents, the shareholder has a cash flow of minus $9. That's the same as the shareholder of the leveraged firm, but here it's the shareholder of the unleveraged firm. Going down to the top earnings per share of $20 for the unleveraged firm, the shareholder receives twice that $20 or $40, but then has to subtract from it the $10 of debt service. And as you can see, the shareholder's cash flow from homemade leverage is exactly identical at all levels of earnings before interest of the firm to the EPS of the leveraged firm, even though the shareholder owns shares of the unleveraged firm, because the shareholder has substituted homemade leverage for the leverage of the firm. Leverage analysis tells us that leverage increases expected returns, assuming that the expected returns to investment prior to the deduction of interest exceed the borrowing rate. That leverage also increases risk. Leverage analysis does not show the effect of leverage on the value of the corporation, because a rise in expected returns increases the value of the corporation if the cost of capital is constant, but increased risk increases the cost of capital, which reduces the value of the corporation. On September 22nd, 2015, a great ball player died, Yogi Berra. Yogi Berra is famous not only for great ball-playing skills, but also for the way that he spoke. It ain't over till it's over. He went to a dinner in an Italian restaurant, and when he was asked how many slices his pizza should be cut into, he said, "You'd better make it 4, 'cause I don't think I could eat 8. Yogi Berra's quote is at the heart of the pizza theory, or the pie model, of the effect of changes on firm value caused by changes in capital structure. The theory is this: the size of the pie does not depend on how it's sliced. The pizza theory is more properly known as the Modigliani-Miller theory. The Modigliani-Miller theory was devised by Franco Modigliani and Merton Miller. You'll remember Merton Miller from our previous lecture because I showed his face in the winners of the 1990 Nobel Prize. Franco Modigliani, who is actually Merton Miller's professor at the University of Chicago, won the Nobel Prize earlier than his student, and he won it for pioneering analysis of savings and for analysis of financial markets. The MM theory was written up in the June 1958 American Economic Review. The cost of capital, corporation finance and the theory of investment. And it's one of the classics that started finance as an academic pursuit. M&M directly addressed the question of debt equity structure, or the capital structure that the firm should have. They said that there is no optimal capital structure, or in their words, the average cost of capital to any firm is completely independent of its capital structure and is equal to the capitalization rate of a pure equity stream of its class. M&M's paper was as important for how they proved their proposition as for what they actually said. They proved their proposition by an arbitrage argument, where they mathematically demonstrated that, assuming market efficiencies, homemade leverage would lead to synthetic and outright securities with identical cash flows, which should be priced identically in a single market. Their proof revolved around the identity of a firm with leverage on its balance sheet and an unleveraged firm's cash flows where the investor synthesizes the leveraged firm with homemade leverage. Proposition 2 in the paper takes as its starting point the idea that total cash flow returns from assets to all contributors of capital are conserved, and the weighted average cost of capital formula, where the weighted average cost of capital, or the returns from assets to investors of a corporation, is equal to the cost of capital for equity times the weighting of equity plus the cost of capital for debt times the weighting of debt. Solving the weighted average cost of capital formula for the cost of equity, we find that the cost of equity is equal to the return on assets plus the spread between the return on assets and the return of debt times the debt-equity ratio. The paper caused a certain amount of controversy. Particularly, people pointed out that Modigliani and Miller had ignored taxes, so in 1963 they published an amendment to their paper. Debt and equity investors are only two of the claimants on the firm's value. A third claimant is the taxation authority, the government, and the taxation authority typically takes tax after the deduction of interest. So interest, which is a payout to one of the investors in the firm, the debt investors, is actually tax deductible, and one can reduce the tax burden of the firm by the use of debt. The benefits for the use of debt accrue to the residual owners of the firm, that is to say, the equity holders. So how much is this worth? You can think of the interest tax shield value as a perpetuity. So the value of a perpetuity is simply its annual cash flow divided by the interest rate, and the annual value of the perpetuity is the taxes, this is the tax rate, that are saved on interest. The interest is simply the principal of the debt times the interest rate. So it's the tax rate times the principal times the interest rate divided by the interest rate, or the tax rate times the total debt. So we find that relative to the firm that pays taxes but has no debt, the value of the leveraged firm is increased. It's increased by the product of the tax rate times the debt. So here's the value of the unleveraged firm, and the value of the leveraged firm is greater than the value of the unleveraged firm by the interest rate tax shield. Plugging those values into the cost of equity formula, we find that M&M with taxes says that the cost of equity is equal to a return on the unleveraged firm, the cost of equity for the unleveraged firm, times the debt spread, times 1 minus t, times the debt-equity ratio. So we can see that the after-tax cost of equity increases with leverage, but it doesn't increase as fast as it would have increased without taxes, because money that's gone to the tax authorities now stays with the investors and is not a deadweight cost to the company. I want to go back to the example of Leverage Corp to clarify the M&M with taxes issues. Let's go back to the spreadsheet.